Here we're going to be looking at an impressed petty cash system and how we'd account for this petty cash. So what are we talking about? We set up this petty cash account here, or it's cash that's available for paying off miscellaneous expenses, which would be impractical to pay by check. And a person would be responsible for this petty cash fund here. And what it does here is there's cash taken out of it and receipts are deposited for the cash that is taken out here, and it's got an impressed amount here. In this case we're going to be looking at $400, and that means it's going to stay constant here, this petty cash here, for those paying out those expenses. So what we do here is we take from our regular cash account, we credit it or reduce it here for $400, and then we would debit or increase our petty cash account here for $400. But let's go and look at how this actually works in the practical application here. So a petty cash is an impressed account. It always has the same balance. An exact amount of cash is deposited into the account for a known specific purpose. And in this case, we're going to look at it as miscellaneous employee expenses here. To start the petty cash fund, we transferred cash. In this case, it was $400 to the petty cash account, and we put $400 cash in a petty cash box here, or a till, have you. And there's a person going to be responsible for dispersing this cash here. And then when small purchases is made here, or an employee or cash advance is made to an employee, the employee is reimbursed from the petty cash box here in cash. So the employee puts the receipt for the amount that they were reimbursed back into this petty cash box here. So the total in the box between the remaining cash and the receipts should always be equal to the balance that's assigned. And in this case, we're going to have $400 in that petty cash box and on the petty cash account. So when the amount of petty cash remaining gets low, the petty cash funds must be replenished here. The company transfers cash from the cash account equal to the total of all the receipts in the box plus or minus any overages or shortages, debiting the appropriate accounts per the receipts record here. So whatever receipts they have to go in and debit those receipts here, or either as an expense account or some accounts receivable from some employee. And they would be crediting the cash account. The cash in the amount of the transfer goes into the petty cash box to bring the total petty cash back to the assigned amount here. In this case, it's $400. So no entry is made to the petty cash account, since its balance should always be the original amount funded. In this example, it will be for $400 again, unless it's determined that the petty cash account should be either increased or decreased. So next, let's go and we'll look at how this petty cash account actually functions. Here we're going to look at an example of some petty cash transactions and how we'd account for them. Now we're getting to the point here in our petty cash account where we're running low on cash, and we have to go back to the regular cash account and transfer some more cash into the petty cash account here. And what we have to do before we go and get this cash is we have to prove that we have receipts for all our disbursements here. So in this case, we're going to have a number of expenses here, and we also have some employee advances that are due back here into this account, and we have to come up with determine if we have any cash overages or cash shortages in this account here. So what we would do is we take look at our petty cash or impressed amount. That's the $400 in this example here. That's the amount that we started with, and that in our petty cash account here. And then we have disbursements with receipts. We got receipts for the disbursements we made here of $356. So the cash that should be in the account here should be the petty cash amount that we started with here at $400, less the receipts that we have for our disbursements. Those are the cash that we paid out here of $356. So we should have a balance sitting or remaining in this petty cash account here or in petty cash here for $44. Now we did an actual cash account here for our petty cash, and we determined that it was $24. So you can see here we're short by $20. The $44 here minus the $24 gives us a shortage here in our account by $20. So what we have to do is we have to set up a cash over and short account here, when we'd be adding that $20 here to the disbursements for the expenses that we paid out to these employees. So the total amount here dispersed was $376, and that's what has to be replenished here. The $400 amount, the beginning amount here, less the actual cash account here at $24 equals $376. So let's go and look at how we replenish this account here. To replenish the petty cash fund, you will include a credit here to cash for $376. That we would be reducing our cash account here by $376, and that's the amount that's needed to get the petty cash on hand back to the impressed amount here of $400. We have to bring our petty cash account here back to $400. So we would credit our cash account here for $376, and then we'd be debiting our petty cash here for $376. We're actually bringing this cash into this petty cash account. Now I'm showing here that I've got a credit here for $376. That you wouldn't actually record. There's no entry made here. I'm only showing that here for demonstrating purposes because that's the amount of cash that was actually paid out, the $376. And by replenishing it here, this credit amount, moving it over here to a debit amount, or the cash that we got here from the regular account to $376, brings the amount here, the impressed amount as we call, back to $400. So we're sitting with $400 in our petty cash account. So now what do we do here? Now we have to look at those disbursements that we made here, the ones that we have receipts for, and we actually have to record those on our balance sheet here. But before we do that, the petty cash transactions are not recorded until the fund is reimbursed or replenished, and that's what we did above here. We reimbursed that petty cash fund here for $376. So now we can go and we have to record these receipts that we have on our balance sheet. So we had some delivery expenses here for $120, some supplies expenses for $50, some postage expenses here for $80, and then we also had some miscellaneous expenses here for $72. So we go over here and we would actually be recording this as an expense account on our income statement, the $120, the $50, the $80 here, and the $72. But what we would do is we'd be recording them to the expense for the applicable account. We'd have probably account set up for each one of these here, but I'm just throwing them all into one expense account here. We'd have to record that here. Then we have this other account here, this accounts receivable from an employee of $34. That was a cash advance made to an employee here, and the employee has to pay that back to the company. So what we do in this case is we set up accounts receivable from the employee here, and then for the petty cash, and we debit that or increase that here for $34. So that would act as an asset here on our balance sheet, but we have to set up that account here. And then one other thing, this is for this cash over and short here. This is how we'd handle that. And in this case, it was $20 that we had to account for. So we would go down to a cash over and we set up this cash over and short account here, and it's actually an expense account. So you got your debits here, and we would debit it or increase it here for $20 because we recognize that as an expense. Now, just to further explain this cash over and short here. Okay, for the cash over and short, if the petty cash fund fails to prove out, and if it's short, we would debit it here because it acts as an expense account. And if it was over here, we would credit here. We would credit or reduce our expense here, credit it, if it was over by $20. So it depends on our cash account. This is how we account for any overages or shortages. So in this example, if our cash was more then the cash count here was greater than the receipts we have, then we would actually be crediting or reducing our expense account here. In this case, the receipts here were less than we had less receipts here than the actual cash paid out, so we would debit our cash over and short. Now there's one last thing we have to look at here. Say, for example, here that we determined our petty cash was the $400 we had in this petty cash fund here was not enough to cover our disbursements that we normally make. So we're going to increase it here by $200. So we want to bring it up here to $600. And that's easy enough to see here. Again, we go down to our cash account here, and we'd credit or reduce our cash here for $200, and then we would go and we'd debit our petty cash account here for $200. So we've increased our petty cash impressed amount here from $400 by the $200 up to the $600 amount. Now, in the case that if we had too much petty cash, we would go in and we'd be crediting our petty cash account here, and then we'd be debiting or increasing our regular cash account here. So this is an example here of how we'd handle our petty cash fund here with some typical disbursements that we make here. But remember here, when we're going back to there and getting some cash here to replenish this account, we have to do this cash count here to make sure that we have our receipts for our disbursements for our receipts equal the actual cash that we paid out. If not, then we have to set up this cash over and short account here to account for any overages or shortages here in our cash based on the total disbursements that we made.